to prevent currency reserve from shivering in inflation coldness. During recent weeks, people are waiting for Fed to declare its final decision about the interest rate policy, which is going to be put in place for the current year and maybe next year. We have discussed it previously, but in this video we will address it from the different aspects. According to Max Weber's opinion, the cognition cannot be a reproduction or a copy equal to the original version of reality. Rather, the reality is such infinite that it's impossible to fully understand it. Hence, we have to select aspects and parts of it to study. Yes, I agree with you. It is so similar to the uncertainty principle in physics, which implies that, in general, it's impossible to predict the value of a quantity with arbitrary certainty, even if all initial conditions are specified. By the way, it is so encouraging that you are our companions in this journey to find the lost economic chain rings. After this prelude, we go back straight to the interest rate story. In the absence of a direct and exact decision from Fed about the matter, we are witnessing the presence of a lot of speculations. The presented speculations of these days are being accompanied by the low level of probability of going to happen. The question is, why? Where do this confusion and indecision come from? They are rooted in these elements. Number 1. Rising interest rate has a negative effect on the price of the bonds which pay a fixed interest rate, because the investors will no longer be interested in the lower fixed interest rate of current bonds. Then the yields of these bonds will go up. The whole of this can become the cause of the fall in the currency reserve value that these bonds have been denominated in it in comparison to other currency reserves. Therefore, the capital will fly toward the alternatives. In this situation, the rising interest that has been prescribed as a cure now becomes the disease cause itself. Number 2. Lowering the level of the money in the circulation is a result of increasing the interest rate, which means it becomes more expensive for individuals to get a student loan or a mortgage, and also for the firms to buy new machinery and build new factories. In one word, recession. We have discussed more about this part in an expansionary fiscal policy video before, and its link has been put under this video if you are interested in. Number 3. A high level of inflation is more harmful for a currency reserve in comparison to other currencies, because the values of the other currencies are calculated according to the values of the currency reserves. But how can a currency reserve create a warm atmosphere of stability for other currencies, while it itself is shivering from the inflation coldness? There is a missing element here which has shadowed on the wisdom and led to the confusion and indecision, which is nothing except the positive interest rate. As a simple definition, the price of the money is called the interest rate. Not long ago, on the one hand, the central banks used to set their interest rates a positive number, and that was the guarantee of the people's interests, because it preserved the real value of their money and savings. Also, it was the element that made banks to pay their clients a share of the profit. On the other hand, the banks had no access to the easy money, and they needed people's money to be able to make the investments. Hence, it was rational for the clients to receive a share from the bank's profit. Of course, the main share of the profit belonged to the banks, because they had execution expenses, and also the banks were the parts who faced the risk. It has to be mentioned here that the client share was being calculated in accordance to the central bank's positive interest rate, as it is the criteria to evaluate the value of the money. In conclusion, if a positive number is set by Fed as the interest rate and if the share of people is paid according to it, it is predictable that the economy won't go deeper in the recession, especially because people have more confidence on their money value and profit in the banks. Therefore, they will spend and invest with more confidence. These spending and investing, which are done by the people, will neutralize the reasonable amount of the toxic effect of the increasing in the bond yields. In addition, after a short time, the investors will come back because nothing is more desirable for an investor than the surfing on the strong currency reserve waves in the stable and growing economic sea. To get informed about the future videos publishing, please click on the subscribe. Of course, you can make us grateful by commenting your wise opinions and suggestions for future subjects in the comment section. See you soon.